Will Powell finally cut rates? That's the question now echoing through Wall Street, Capitol Hill, and every trading terminal in between. This pressure has been building up for months, tightening from all sides with every data release, policy shift, and market change. There is no single trigger here. It's just a steady buildup of pressure that could cause the whole system to crack open. And the people holding the bag won't be the ones who built it. As if that wasn't enough, Trump is also turning up the heat. The dollar is sliding, and Buffett's long-tested indicator just hit all-time highs. And the Congress? Well, they just passed Trump's big beautiful bill and dropped a $7 trillion mega bill that rewrites the rules for fiscal restraint. The Fed is no longer just watching the data. It's trapped between political demands, economic stress, and a market that's spiraling into narrative overdrive. So the question now is, will Powell finally cut? And if he does, will it even matter? This week's recap video focuses on the Fed, Powell, rate cuts, and the growing macro pressure that's shaping their every move. I'll walk through how all this ties together. Falling dollar, exploding market cap, Buffett's overvaluation alarm, euphoric liquidity-driven rallies, and the new budget bill's impact on future policy. I'll also highlight the most important economic reports and earnings to watch for next week. This video will be a bit different. I'm not covering chart breakdowns here because I want the focus to stay on the macro. If you want those setups, make sure you're subscribed to the free newsletter. I'll send a detailed chart breakdown before the market opens on Monday. I'll also include a few new names I'm watching, both for trade setups and long-term plays. Let's get into this now. Imagine this. You're Jerome Powell, chair of Federal Reserve, and you got a nation breathing down your neck. On one side, inflation is sticky. On the other, the labor market is wobbling. Meanwhile, the stock market continues to rally, driven by persistent liquidity and optimism, even as the underlying fundamentals show signs of strain. And then, a handwritten note arrives. Scribbled across a chart of global interest rates is a message from none other than Donald Trump saying to cut rates by a lot. If there's ever been a more literal example of pressure, it's this. Political theater meets monetary policy, and the stage is set for fireworks. But let's just back up a bit. The story of the week, and arguably the year, is a battle of narratives. Is the economy resilient or fragile? Are markets healthy or hallucinating? And is Powell about to pivot or play hardball? Enter the Buffett Indicator. This classic valuation metric compares total US market cap to GDP. Historically, anything above 100% was a yellow light. Above 120%, red light. And today, it's sitting at 210%, an all-time high. Warren Buffett once said, "Be fearful when others are greedy." Well, based on this chart, investor sentiment appears euphoric and increasingly disconnected from economic reality. Now, I know there are people with IQs lower than room temperature who will say, "Bro, the Buffett indicator is skewed. You're not accounting for the economic growth we're going to have over the next few years. It will catch up and fix the ratio." And to that, honestly, I don't even know where to begin with. First of all, I don't see how this economy grows with the structural problems we have. And we already got Q2 GDP print and it was negative. Second, are you seriously telling me economic output is going to double in a few years to bring that ratio back to 100%? Is that really your argument? Have you even considered what that implies? Which is more likely, the economy doubling over the next few years to justify these valuations, or the market pulling back to more realistic levels? I leave it at that. So let's bring this back to valuations and what the market is actually pricing in. The total US market cap has ballooned to $63.8 trillion, reaching an all-time high. To show how absurd this number is, according to recent studies, it's now larger than combined market caps of Europe, China, Hong Kong, Japan, India, the UK, Brazil, and Mexico. And that kind of dominance raises real questions about how sustainable this really is. But dominance doesn't equal safety. While financial markets climb, the economy beneath isn't keeping pace, pressured by rising debt, higher costs, and long-term structural issues. It's also worth noting how concentrated this rally has become. According to Goldman Sachs, the top 10% of the largest US stocks now account for 76% of the entire market's value, the most extreme concentration in history. That's higher than 1930s. And since the great financial crisis, this group's weight has surged over 15 percentage points. In short, this market isn't just overvalued, it's top-heavy. And the higher it climbs on the backs of few mega-cap names, the more vulnerable it becomes to even a small shift in sentiment. Picture a mansion built on cracked foundation. Impressive to look at, but potentially dangerous if the ground shifts. And this is where it gets more dramatic. Trump isn't just making noise online. He's campaigning on the idea that Powell has wrecked the economy with high rates. His hand-delivered note isn't just a tantrum, it's a signal. If Powell won't cut, someone else will. But Powell isn't exactly relaxing. According to the Fed's latest summary of economic projections, 14 officials flagged upside risks to both inflation and unemployment. That kind of dual threat is rare, and it's a clear signal the Fed sees the balance of risks shifting in the wrong direction. This is the scenario policymakers dread. Inflation that doesn't fade, paired with a job market that starts to roll over. It's the early shape of stagflation, something we've been calling out for months on this channel, even if the Fed isn't ready to say it out loud. Now let's talk labor. This week's ADP report came in hot with a cold slap, a loss of 33,000 private sector jobs in June. That's the first red print in over a year. Meanwhile, the non-farm payroll report showed a gain of 147,000 jobs, above the expectation. But, and this is a big but, more than 70,000 of those jobs came from government hiring. So while ADP was flashing private sector slowdown, the non-farm payroll was basically shouting, "Don't worry, the government's got you." And when you peel back the onion, it gets worse. The number of part-time workers who want full-time jobs just hit 4.5 million. Full-time job growth is stalling. Labor force participation is still stuck at 62.3%, well below pre-COVID norms. So yes, technically people are working, but many of them are juggling multiple gigs, contracts, and part-time jobs to just make ends meet. Meanwhile, markets are plowing ahead like nothing is wrong. NVDA keeps printing new highs. AI stocks are the new crypto, but insiders aren't buying the hype. NVIDIA execs dumped over $1 billion in stock, half of it just the past month alone. Which brings us back to Powell's dilemma. Cut rates now, and he risks throwing gasoline on inflation. Hold steady, and he risks watching the labor market start to crack. Oh, did I even mention the debt? Congress just passed a big, beautiful bill, which promises to spend $7 trillion annually while collecting only $5 trillion in revenue. That's $2 trillion annual deficit locked in for the foreseeable future. This bill also delivers $4.5 trillion in tax cuts, and most of that goes straight to wealthy households and big businesses. We're talking expanded deductions, more tax breaks, and loopholes that make the rich even richer. Add in $158 billion for defense, and another $175 billion for border security and ICE. And the spending pile just grows fast. So how are they paying for it? Well, they are not. Instead, they are slashing programs like Medicaid and SNAP, which could take away healthcare and food assistance from over 12 million Americans by 2034. Yes, there are some perks for regular families too, like bigger child tax credits, better deductions, and some help for tipped workers. But when you zoom out, the bill clearly favors the top of the food chain. The rich get tax breaks, and the rest get leftovers. So really not much has changed from the last few administrations. Killing off the middle class still seems to be the long-term plan. According to the Congressional Budget Office, this package adds between $2.4 to $2.8 trillion to the deficit over the next decade. Yale's budget lab projects a short-term sugar high of 0.2% annual GDP growth through 2027, followed by a long-term drag that could leave the economy around 3% smaller by 2054 than it would have been without the bill. That's largely because of the rising interest costs from all the borrowing and the persistent gap between government spending and revenue. And that's where the Fed comes in. A persistent structural deficit means the Treasury is issuing new debt consistently. This isn't a cyclical blip. It's baked into the system now. The more supply hits the bond market, the harder it is to keep yields stable unless someone steps in, and that someone is usually the Fed. This limits Powell's room to maneuver. He can't aggressively hike rates if doing so drives interest costs even higher. At some point, rate policy becomes less about inflation management and more about debt service math. So when Powell says he's data dependent, keep in mind, fiscal dominance is data too. Ray Dalio, founder of Bridgewater Associates and a titan of global macro investing, didn't hold back. He warned the US is heading towards 130% debt to GDP ratio, with interest payments already surpassing $1 trillion per year. That's more than the entire military budget. And it gets worse. Dalio projects that over the next decade, as the debt grows and interest cost balloons towards $2 trillion annually, the burden per American household could hit $425,000. Congrats, you just inherited a debt you didn't ask for. And how is the government financing this? Well, by issuing more debt. $1.7 trillion in treasuries this year alone, which dwarfs corporate bond issuance. That much supply puts pressure on yields. And if demand doesn't show up, well, guess who gets to buy the leftovers? Yep, it's the Fed. Print money to buy debt, devalue the dollar, suppress rates. Rinse and repeat. Sounds familiar? It's financial repression, and it's quietly becoming the unofficial playbook. And the dollar, well, it's quietly breaking down. The DIX is back near multi-month low, and that's no accident. With over $34 trillion in debt, and nearly 9.2 trillion of it maturing this year alone, which is about 30% of the annual GDP, the refinancing pressure is massive. The playbook is simple: lower rates and weaken the dollar to keep the machine running. It's not just about cutting. It's about rolling over trillions at cheaper rates. That buys time politically and financially, but the side effects are real. A softer dollar means imported inflation, rising commodity prices, and more pain for consumers. When the math doesn't work anymore, the focus shifts from keeping things stable to just keeping things from falling apart. Meanwhile, more storm clouds are building. Office real estate delinquencies just hit 11.1%. Topping the 2009 crisis peak. Remote work is no longer just a trend. It's rapidly eroding the value of commercial real estate, and the consequences are starting to show up across banks, rates, and credit markets. Microsoft is also laying off 9,000 workers, joining a tech sector that's tightening belts. Credit markets are stressed, consumers are stretched, and the Treasury is crowding out private lending. But Wall Street is still partying. It's the classic split between the real and the financial economy. One is softening, the other is floating higher. And somewhere in between, Powell is trying to hold everything together with one hand on the rate lever and the other on a stress ball. If you're a trader or investor trying to make sense of this, here's the takeaway. This market is priced for the best case scenario, while the fundamentals are showing cracks. Consumer demand is softening, job quality is slipping, and inflation is still sticky. Meanwhile, the Fed is stuck between conflicting mandates, and the political noise is only getting louder. And then there is Buffett's gauge at an all-time high, signaling historical overvaluation. It's the kind of reading that doesn't come around often, and when it does, it usually doesn't end quietly. Expectations are still pricing in 1 or 2 cuts by year end. But here's my read on it. I think it's becoming highly likely the Fed cuts within the next month or 2, but not for the reasons the market originally hoped for. This wouldn't be a mission accomplished cut. It would be we can't afford to break anything else cut. Based on how the macro is unfolding, my current bias is that Powell will be forced into easing as stress builds under the surface. This is my view based on the current macro landscape, but of course, things can change quickly, and I'm always open to adjusting when the data shifts. That's why risk management always comes in first. No matter how confident you feel in the setup or the narrative, protect your capital, stay nimble, and stay humble. If this video helped make sense of this mess, hit like and subscribe. And since I'm keeping the focus strictly on the macro this week, I won't be covering chart setups here. Instead, make sure you're on the free newsletter. I'll send those setups out before Monday's open. You'll also get names I'm watching for trades and longer term positioning, plus the thinking behind all that. And yes, it's still free for now. Now, let's take a look at the economic and earnings reports for the week ahead. On Monday, there are no major economic events scheduled. On Tuesday, we have NFIB Optimism Index and Consumer Credit. On Wednesday, we have wholesale inventories and FOMC minutes. On Thursday, we have jobless claims and we have 2 Fed speakers. On Friday, we have the monthly federal budget. On the earnings front, it's only Thursday that stands out. We have Delta, Conagra, Levi's, WD-40, PriceSmart, and Helen of Troy. These will test both consumer resilience and margin strength as input costs remain sticky. So to recap, Powell is boxed in. Political pressure is mounting, inflation is still sticky, the labor market is wobbling, and debt burdens are exploding. All while markets keep climbing like they're seeing a different reality altogether. Buffett's long-tested indicator just hit all-time highs. The dollar is slipping, and Congress just signed off on a $7 trillion mega bill that supercharges deficits and ties the Fed's hand even further. We're staring down $9.2 trillion in maturing debt this year. That's nearly a third of the annual GDP, and the deficit math just simply doesn't work. My take, I think the Fed will be forced to cut rates in the next month or two. Not because inflation is tamed, but because the system is cracking. This won't be a confidence cut. It will be a cut to keep things from breaking. That's where my bias stands right now, but I'll always stay open if the data shifts. So if this gave you more clarity heading into next week, hit like, subscribe, and get on the newsletter. That's where I send the chart breakdowns and trade setups I held back from this video, plus new names I'm watching and how I'm thinking about them and why they matter. Also, drop a comment with what setups or macro themes you're tracking this week. Thanks for watching, and I will see you in the next one.